Hello, everyone, and welcome to MUFG in Conversation, our series dedicated to exploring timely topics with key industry leaders in the innovation ecosystem. My name is Priya Rajan. I'm the Managing Director responsible for national VC coverage at our MUFG's Tech Banking Group. Today, I'm super excited to welcome my dear friend Rashmi, General Partner at B Capital Group. B Capital is a multi-stage global VC firm with over $6 billion in assets investing in groundbreaking tech companies focusing on transformative sectors such as enterprise software, fintech, and healthcare. Rashmi is currently a general partner at B Capital, leading investments in enterprise software sectors. Prior to B Capital, she was at M12 and Intel Capital prior to that. Excited to welcome Rashmi, and Rashmi, thank you so much for joining us.
Thanks so much for having me, Priya. Great to be talking today.
Rashmi, can you share a bit about your journey and what you got to what you're doing today, and a bit of Fun's background, the team, and what are you focused on?
So I've had, I would say, a fairly non-traditional path into venture capital. Had an undergrad degree in engineering, built software products for large companies like Oracle and GE Healthcare in the past, mainly in database, DevOps, and data analytics spaces. And then after my MBA program at Kellogg, switched into venture capital, first with Intel Capital, where my focus was investing in enterprise software technologies. Had the opportunity to invest in really interesting companies across cloud infrastructure, database, cybersecurity, and mobile companies. Post that, decided to get some operating experience to help me come back as a more credible investor with founders and have more empathy to a lot of the difficult trials and tribulations that founders go through. So ended up first going to a seed stage cloud infrastructure company, which was one of my portfolio companies from Intel Capital, a company called Blue Data, where I ran product marketing, business development, a bunch of go-to-market roles. The company ended up getting acquired by HPE. I post Blue Data, I went to a growth stage startup in the Valley called Couchbase, which is in the NoSQL database space. And then my role was to lead the business development team, build out our channel partnerships, our OEM cloud partnerships, and really help drive the non-direct sales-led revenue for the company. Did that for 2.5 years before coming back on the investing side with M12. Couchbase since went IPO about 2.5 years back. And my role at M12 as part of the founding team member was to help build out the corporate venture team and platform for M12. My focus was still the same, so continued to invest in enterprise software. Invested in about 15 transactions during my time there across data infrastructure, cloud infrastructure, cybersecurity, vertical SaaS, as well as enterprise software used within corporate teams. And post M12 have been at B Capital now for 4.5 years, where I lead our global enterprise software practice for the fund. Being focused on all the same areas that I've been investing in, operating in for the past 25 years. Have invested in about 26 companies here at B Capital, mainly focused on North America, Europe, and Israel as geographies to invest in. And like you mentioned, B Capital is a global fund. We started back in 2016 with a growth fund. We've since added a few additional funds to the platform. We launched an early stage fund a couple years back. We launched a healthcare fund. We're recently kicking off our climate fund. About 6.5 billion assets under management at this point, 180 portfolio companies. We have teams that are globally distributed across North America and Asia. And yeah, it's been a fantastic journey over the past 4.5 years, continuing to help build the brand for the fund.
You've got a unique background from an operator to an investor. Moving from CVC to a big global institutional investor such as B Capital. What are some of the key insights that you've learned along the way?
Yeah, I would say one of the key experiences that I rely on pretty heavily is definitely that technical experience that I've built from my product operating days, as well as the go-to-market experience from the startup operating days. That's something that comes, I would say, to great use both on the diligence side, but more importantly, on the portfolio value add piece, where we're working with portfolio companies to help them navigate the next 5, 7, 10 years of their journey. Personally, I would say a few uh, learnings for me along the way, which I think will be very relevant for underrepresented minorities and females that are listening to this podcast. One, don't take no for an answer. There are a lot of naysayers that you meet across the path. Ultimately, you control your own destiny. And while a path may seem riskier or may seem non traditional, raising your hands for those tough projects and signing up for those riskier bets actually pays off quite handsomely at the end of it. So definitely feel free to take those bold bets and chart your journey, and it will be incredibly rewarding at the end of it. And look for those role models and sponsors and mentors along the way that can help you brainstorm in terms of how you can build up what could be gaps in your career path and skill sets that you need to acquire. And one of the important skill sets that actually we don't talk about enough, especially for female audience, is the storytelling aspect, which is so critical and important. We all focus so much on doing our jobs right and getting to the right outcome, but a lot of it depends on how you package up your storytelling and make it easier to digest and accessible to many others that you need to send that story out to. So look to build that if you don't have that already, and if you're not spending enough time doing it, it's going to be important as you grow up in your career.
And specifically in the software infrastructure space that you are leaning in, what are some of the interesting trends that you're seeing, and how do you foresee this landscape evolving over the next few years?
Yeah, I would say that there hasn't been a more exciting time to be investing in the infrastructure space. I've always been quite fascinated about how infrastructure is kind of the key underpinning foundational layer on which the rest of the software stack can be built upon. And this includes everything from the silicon and the semiconductor space to the operating layer and the embedded software that sits on top of it, to getting into the compute, storage, and the networking layers on the resource infrastructure space, to then getting into middleware, developer tools, cybersecurity, on which then the application layer sits on top of. There's definitely been, I would say, a continued innovation and evolution of how that has evolved over the last 15 to 20 years. But now a lot of that stack is going to require a reboot or a re-architecture to support all of this heavy compute that we're seeing coming in with AI and Gen AI workloads. And this is not just on the compute and the networking piece of it, which obviously needs to see a significant boost in terms of performance and throughput that layer is going to need to support, but also going into the middleware and the cybersecurity side, where the threat vectors that are now going to be something that we all have to deal with because of Gen AI is going to be completely different than what we have all seen in the past, where creating another deep fake or creating another cyber risk is so much easier. Our kids can do it. I think being able to appropriately protect enterprise assets and infrastructure assets from those threats that come in, applying the right level of data privacy and data security into enterprises that now need to figure out how to protect their code assets and their data assets in a more meaningful way, to developer tools which are completely changing and evolving. We've all seen the rise of coding co-pilots, which are helping on the code completion side, which will now look to gain even more traction and build entire code and run QA and testing. And how do we then upskill or up level what folks are focused on today? So it's a really, really exciting time. Feel like a kid in a candy shop when I look at all the exciting companies building really exciting software today. So there's a lot to look forward to.
And any perspective, one of the debates that we see often, and we talked about this offline as well, the conversation between cloud infra versus on-prem solutions. Any perspective that you can share on that?
Yeah, I would say up until the last better part of the last decade or so, we've been talking about this shift or move to cloud computing, and the rise of SaaS, as we've all witnessed, has been quite game changing in terms of making software applications so much more easier to access by the millions of users everywhere. I think in this age of the rising of Gen AI, we've now seen or starting to see a retreat back to on-prem environments, just because for a lot of enterprises, the ability now to control their code and their data, which is arguably the most valuable IP that companies have, is going to be that much more difficult when you have um, a general purpose foundational model that's running in the cloud, and you have to upload all of your data, all of your code into making it more usable. I think it's definitely creating a lot of concerns with the CISO audience within these enterprises in terms of what does that mean from a data governance, a data ownership standpoint. Um, so from that standpoint, I think there's definitely more of an emphasis on software vendors that can support on-prem environments or hybrid environments or virtual private data centers versus being fully on the cloud. I think there will be a balance in the future as we go towards that, but not one where every application needs to reside in the cloud.
Yeah, that's, well, we're seeing a lot of those conversations happen. So let's see. I think there's a balance for sure. Um, when you're thinking about investing in mid to growth stage company, what are some of the metrics that matter to you?
Yeah, I would say the valuation correction was definitely much needed. Although AI is kind of in its own orbit and valuations there are even surpassing what we saw in 20 and 21. But overall, I would say there definitely has been tempered expectations on valuations going forward in infrastructure spaces, which in the past were quite heated up. And this goes across developer tools and cybersecurity and some areas of data infrastructure which don't have a direct correlation to Gen AI. In terms of the metrics that we look for, I think it's continued to be the same. As growth investors, there's obviously a lot of emphasis that we place on operational efficiency and sustainable growth for these companies. So many of the traditional metrics like LTV to CAC and magic number, rule of 40 is something that we continue to pay a lot of attention to. The one thing that has changed from maybe 2.5 years back is what a profile for a pre-IPO or an IPO company should look like, where in the past companies could go public on 100 million of revenue. Now that bar is much higher. What we've seen with recent IPOs with Klaviyo and Instacart and Arm and other companies, where that bar needs to be in that 3 to 400 range with a path to profitability, or at least visibility into that.
And, and just double clicking on that one specifically, as you're leaning into a company, what are some of the, you've worked with so many companies over the years across your kind of the CVC and now as a part of the B Capital role, what are some of the most common challenges that you see companies face today, especially in this economic environment such as this that we're in, when scaling, and how do you advise them effectively to overcome these challenges? Any examples that you can share would be great as well.
Yeah, I would say for the past 2 years, definitely a lot of work around helping our companies become more efficient. In the past, again, when we were in the zero interest rate period, it was growth at all costs. And um, Many of these companies were growing at 100, 150% year over year, but burning a lot of cash as well, which morphed into let's figure out what's a more sustainable growth path for companies that will not require a heavy capital infusion every 12 to 18 months, but help these companies, like even as early as the Series B, figure out how they can control their own destiny by looking to get to profitability or cash flow break even with the cash on hand. The one balance, however, in this needs to be the balance between growth and profitability. You obviously are going to be a very different profile of a company if you grow at 5-10% every year, but you're profitable. That looks more like a PE scale company, not a venture scale company. And so for venture scale, you want to stay above that 20 to 30% growth rate and get to the profitability profile, especially for late stage companies. So it's finding that right balance. And one of the learnings has also been that it's not easy to jumpstart or accelerate growth when you've slowed down too significantly. So for many companies that did figure out how to grow efficiently, but are growing at 10% now, to grow back to that 30% profile is not going to be the easiest. And which is why we're also seeing a lot of consolidation in the market where they're looking to acquire smaller assets or bringing in companies that can add to the revenue line to help figure out how they can get to a level of growth that becomes interesting again. So yeah, on that balance front, I would say we're still figuring out what is that the right balance for companies at the Series B, C stages. Like for them, a 20% growth would probably be too low. So for those early growth stages, maybe growth in that 50 to 70% would be more appropriate. And then for the later growth stage companies that are getting closer to IPO, a 20 to 30% growth rate, although Rubrik went out at a 46% growth rate, which is fantastic, and a free cash flow margin. I think it's going to be interesting to see what the next set of companies that go for an IPO offering over the next few quarters, like what those companies are going to look like and how would they continue to perform in public markets. There's been so much of volatility. We're all pretty enamored by what we see with the Fantastic Seven, but beyond that, there's just a lot of volatility in those markets.
And IPO exit activity is a topic that comes quite often. Can you share a bit about your perspective on how do you see the year end for 2024? We're almost at the tail end of it. M&A has picked up. There has been a good amount of M&A that has happened earlier in the year. And what do you see that going into 2025 and the end of 2025 is both on M&A and IPO perspective?
Yeah, M&A definitely continues to be quite active. I think companies that have seen that uptick in stock prices would want to leverage more of their stock to continue those acquisitions, as well as the efficiency gains that we have seen many of the public companies also have over the past 2 years has resulted in more cash on the balance sheet, which will lead to more M&As as well. Similarly, on the PE sponsor side as well, we've seen a lot of take privates and consolidations happening. On the IPO front, probably the first half or the middle of 25 is when the floodgates are expected to open. Everyone talks about a pipeline of a few hundreds of startups that are ready to go. I think we're all quite excited about that potential. And on the investor side, it gives us the ability to generate liquidity and pass that back to our limited partners and raise future funds and continue to fund amazing companies that we see every day. So I think from a liquidity standpoint, it's much needed for that to open up. And hopefully we're now seeing inflation start to stabilize and interest rates hopefully starting to come down in the coming quarters.
And closing thoughts, what advice do you have for the founders listening today as they're growing, scaling these companies?
So for early stage founders, the advice would be that it's actually a fairly high bar to go from seed to A. Make sure that you raise enough capital to give yourself the ability to get to those milestones. And the bar has become higher, where in the past it was kind of like a manufacturing floor. You raise a seed, 12 months post, you're raising an A, 12, 18 months post that, you're raising a B. Maybe you get to a million in ARR by the time you raise a B, and nobody would blink an eye. And now the bar is higher, where to raise an A, you need to have at least a million plus in ARR. To raise a B, you need to be at 3 to 5 in ARR, and you need to show that efficient growth that we talked about. And so make sure that you're planning your fundraisers appropriately. The investors that you have at the seed round are going to be able to help support you through maybe a couple more extension rounds if you need to raise that before you get ready for that next round. And for growth stage founders, it's continuing to expand on your product capabilities in a very cash thoughtful way. Um, that's going to be essential. And the more you can be in control of your own destiny by being profitable, you can control the terms and who you would like to add on your cap table.
Thank you. Thank you so much, Rashmi. Super insightful. Really appreciate your time and thank you for joining us. And thanks all for joining us today and looking forward to seeing you all soon.
Thanks, Priya. It was great to talk to you.